ready to unlock the intelligent investor. Think of this deep dive as like getting a master key or something.
I like that.
We're not just summarizing, we're pulling out the good stuff, the timeless wisdom, and figuring out what it means for you in today's market.
Yeah.
So since I know you like to cut to the chase.
And what's amazing is how relevant Graham's insights still are. It's like it's almost like he had a crystal ball.
Right. Like, how did he know? So first things first. Who is this intelligent investor he keeps going on about? When I first read that title, I pictured some Wall Street hotshot, not, someone like me.
That's a really common misunderstanding. Graham actually defines intelligence in investing as more of a character trait. It's about patience, discipline, always being willing to learn, and keeping a cool head when everyone else is losing theirs.
Okay, so less about being a genius and more about having the right temperament. That's actually pretty encouraging. Those are skills you can develop.
Absolutely.
But let's talk about Graham's big distinction between investing and speculating. He seems kind of, I don't know, obsessed with drawing that line in the sand.
He is, and for good reason. Think of investing as building something lasting, brick by brick, focused on what a company is actually worth. Speculation is more like trying to ride a wave. You might get lucky for a bit, but eventually you're going to get wiped out.
So it's about the long game, not trying to game the system.
Exactly. And Graham uses such powerful examples. He even talks about his own mistakes. Like, remember the story of Northern Pipeline?
Yeah.
He bought shares not based on some, hot tip, but because he'd studied the company, knew its worth.
And he made a pretty penny, too.
Over $45 a share. But see, that's different from speculation. He wasn't chasing a quick buck. He saw real value. And that leads us to one of Graham's most famous ideas, Mr. Market.
Ah, yes, Mr. Market, that unpredictable character. So how does Mr. Market play into all of this?
Think of him as that friend, the one who's always offering to buy or sell you stuff. But his prices, all over the place, driven by his mood swings. One day he's euphoric, the next he's gloomy.
Sounds exhausting. So how do we avoid getting caught up in his drama?
That's where the margin of safety comes in. It's like, think of it like adding a buffer to your budget, just in case. For example, you analyze a company and you believe it's worth $100 a share. But buying with the margin of safety, you're looking to buy it at a discount, maybe $70 a share, just in case your initial assessment was a bit off.
So being conservative, leaving room for error, that makes a lot of sense. And speaking of conservative, let's talk about the defensive investor. What does Graham recommend for someone who, really prioritizes stability, steady returns?
He keeps it refreshingly simple, a diversified portfolio split between high-quality bonds and a selection of solid, well-established companies. He even tells these great stories of investors who consistently beat the market using this approach. He called them the super investors of Graham and Doddsville.
Slow and steady wins the race.
Yes, exactly.
But what about those investors who want to be a bit more, I don't know, hands-on? The ones who have the time and energy to really dig deep.
Graham calls them the enterprising investors. And for them, he says, roll up your sleeves and find those hidden gems. Undervalued companies the market's overlooking.
Okay, so less about passively tracking an index and more about, actively seeking out those diamonds in the rough.
Exactly. And he gives you the tools to do it. He's all about diving deep into a company's financial statements, like a financial detective, looking for clues.
Instead of just looking at the stock price, we're learning to read the company's story.
Yes. And one of the biggest red flags he warns about, excessive debt.
Oh, yeah. Debt can be a killer.
He uses the example of Pennsylvania Railroad, once considered a blue-chip company, mind you, to show how too much borrowing can be a recipe for disaster, even for the big guys.
A cautionary tale, if ever I heard one. It's a good reminder that even those big, well-known companies, they can have hidden weaknesses. But it sounds like Graham has a lot to say about analyzing companies. Did he talk about, specific industries, trends to watch out for?
He was actually quite skeptical of chasing the next big thing, especially what they used to call growth stocks.
Which, ironically, everyone's chasing again.
Exactly. And he had good reason to be skeptical. He saw too many investors getting burned, caught up in the hype, without really, truly understanding the business.
It's like that saying, if it sounds too good to be true.
It probably is. And he uses the example of Texas Instruments. Super hot stock back then. Price was through the roof.
People love that stock.
But Graham saw through it, warned people about their earnings, their financial position, and guess what?
It crashed.
Crashed and burned, leaving a lot of people in the red.
It's a good reminder that even in a bull market, you got to be careful, look beyond the hype. But how does this, cautious analytical approach, how does it apply to things like uh, funds? Did Graham have anything to say about those?
He did. He dedicated a whole chapter to funds. He breaks down both, let's see, open-end and closed-end funds, really emphasizes the importance of checking their fees, their track record. What's interesting is that back then, closed-end funds, they often traded at a price that was actually lower than the value of the assets they held.
Wait, so you could like buy a basket of stocks for less than the individual stocks were worth. How does that even?
Right. It's one of those fascinating market quirks, and it shows how, these inefficiencies, they can actually create opportunities if you know where to look. But the bigger point Graham makes is this. Don't chase performance. Don't be swayed by funds with, like, flashy short-term returns. Often, those gains, they disappear just as fast as they came.
So don't judge a book by its cover. Or, I guess, don't judge a stock or a fund by its cover. Look deeper.
Exactly. And this leads to a question I think a lot of investors struggle with. How do you find trustworthy advisors? In this day and age with so much information, so much complexity, can anyone really help us make sense of it all?
Right. It feels like a minefield out there sometimes.
It can, but Graham, he offers some really practical advice in his chapter, The Investor and His Advisors. He says the key is finding someone who puts your interests first. Someone who's not just out to make a quick commission.
He even gives us some, like, tough questions to ask, right? Like, have you ever had a formal complaint filed against you? Straight to the point.
Love it. Because at the end of the day, you're trusting them with your financial well-being. Don't be afraid to ask the hard questions. Do your homework. Graham really gets into the weeds, too. Analyzing a company's capital structure, their earnings record, their dividend history.
It sounds intense. Does he expect, like, everyday investors to become, like, mini analysts?
He acknowledges that not everyone has the time or the expertise to analyze every single company. But his point is, you don't have to be a Wall Street whiz to evaluate a company's financial health. Start simple. Look at their debt. Graham was a huge advocate for companies with strong financial positions, particularly those with little to no debt. He saw too much debt as a major, major red flag.
And didn't he have, like, a specific example of this?
He did. Pennsylvania Railroad. He uses that as a cautionary tale. Because even though they were huge, well-established, he saw their excessive borrowing as a weakness that eventually contributed to their decline.
So even if a company looks good at first glance, always check under the hood.
Always. And don't get fixated on the latest earnings report. Graham encourages a long-term perspective. Look at a company's performance over, several years. Are they consistently profitable? Are their earnings growing? He wants you to see beyond the noise, the short-term fluctuations, and focus on the big picture. Remember, a true investor, they're not trying to time the market. They're not trying to predict every single twist and turn.
He even goes so far as to say, the investor would be better off if his stocks had no market quotation at all, just to avoid that daily anxiety. It's a pretty radical thought, but I get it.
Right, and that just underscores his point. Investing should be about owning a piece of a business, not gambling on stock prices.
So how do we tune out the noise? How do we avoid becoming our own worst enemies when it comes to investing?
That's where one of the most powerful chapters in the book comes in, Mr. Market and the Margin of Safety. Graham argues that investors, they should see themselves as business analysts, not stock market speculators, that friend we talked about, the one with the wild mood swings. The market's the same way.
So ignore the hype, focus on the fundamentals, and buy when Mr. Market offers you a good deal.
Exactly. And he uses such vivid examples to illustrate this point. Companies like Chrysler, Northern Pacific, shows how market sentiment can really push prices away from, what a company is actually worth. And to avoid those impulsive decisions, he stresses diversification.
Don't put all your eggs in one basket.
Right. He suggests holding a diverse portfolio, at least 10, but no more than 30 different stocks. Don't get too fixated on any single company, no matter how promising it seems. Of course, the investing landscape has changed since Graham's time.
You're talking about things like index funds,
right.
ETFs.
Exactly. Those weren't around back then. And index funds, they hold hundreds, sometimes thousands of stocks. So they've become a really popular way to get that instant diversification. Definitely something to consider when you're building a portfolio today.
So while some of his specific recommendations might need, like, a modern update, his core principles still hold up.
They absolutely do. His emphasis on value, on managing your risk, on keeping a cool head when everyone else is freaking out, those are timeless strategies for success in any era.
It really shows you how powerful his ideas were. He wasn't about getting rich quick. He was about building wealth, but the right way. Smart, disciplined. And it's amazing how well his principles have held up.
Yeah.
I mean, think about it. The tech bubble, the '08 crisis, even all the craziness during the pandemic. Those who really stuck with Graham's approach, they weathered the storm a lot better than those who were chasing the flavor of the month.
It's a testament to how much he understood. The market, it's driven by logic, sure, but also emotion. And those emotions, sometimes they lead us to make bad decisions.
Right.
Fear might make us sell at the absolute worst time. And then greed makes us, take these crazy risks that we regret later.
It's like he's saying the real risk isn't the market itself, it's how we react to it.
Exactly. He says a true intelligent investor, it's not about being some kind of genius who can predict the future, it's about temperament.
Keeping a cool head.
Yes. Having the discipline to stick with your plan, even when things get a little, yeah. There's one more case study I wanted to mention, though, Aetna Maintenance. I think it really sums up a lot of Graham's warnings about speculation.
Oh yeah, Aetna Maintenance. A classic cautionary tale. What was it about again?
It perfectly illustrates what happens when hype takes over. When people forget about the fundamentals, Aetna, it was the hot stock. Everyone wanted a piece. The price, it was skyrocketing. Based on, well, promises mostly. And some, let's just say, creative accounting.
And Graham, he wasn't buying it. He warned people.
Right.
He talked about their earnings being inflated, their financials being shaky.
And of course he was right. The stock tanked, wiped out a lot of people who got caught up in
The frenzy.
frenzy.
Yeah.
It all comes back to that question. Are you investing or are you speculating? Are you buying a piece of a business or are you just, rolling the dice?
Hoping for the best.
Right. And The Intelligent Investor, even though it was written, 70 years ago, it still gives us this incredibly useful framework for thinking about the market.
Totally. It's a good reminder that the tools, they might change. Technology changes. But the fundamentals, the principles of sound investing,
Those are timeless.
they're timeless.
Yeah.
Well said. Well, I think that about wraps it up for a deep dive into The Intelligent Investor.
Fantastic book.
So much to think about. So until next time, keep those pages turning, and remember, knowledge is power.